Select the zero tax bracket option on your retirement plan. In this episode, I'm going to address the question, what is the best way to save for a comfortable retirement? It's not what you think. And at the end of this episode, I'm going to show you how you can get my latest best-selling book. It's over 300 pages of information and 62 actual client stories that will show you the best way to save for a comfortable retirement and not outlive your money. So I have a little ditty. It goes, good, better, best. Never let it rest. Never let it rest till good gets better and better gets best. I used to say that IRAs and 401ks were a good way to go. I don't agree now. I think they're a poor way to go, and you'll see why. It's a far cry from the best way. Roth IRAs and 401ks are a better way to go. But I've never owned an IRA or 401k, never will. I've never owned a Roth IRA or 401k, never will, because I like to just go straight to the best. So let me explain what I'm talking about by talking about the 4 phases of retirement planning. My name's Doug Andrew. I've been a financial strategist, retirement planning specialist for 4.5 decades. I've been honored to author 11 books that have all been bestsellers, and I'm going to show you how you can learn more and empower yourself to not outlive your money, have a comfortable retirement, and actually get by with a smaller nest egg and have the same income that people take out of IRAs or 401ks in the normal financial services industry standard out there. Or if you have the same amount as your friend or neighbor, I'll show you how to have twice as much income out of your nest egg than they probably will get out of their nest egg. So what are the 4 phases of retirement planning? The first phase is what we call the contribution phase. This is where you're contributing money to accounts, saving for the future. That phase overlaps the accumulation phase, where hopefully you're earning interest, dividends, what have you. You're making money. And the next phase is a distribution phase. Maybe people call it the withdrawal phase, but I found that many people go into withdrawal when they hit that phase because they realize they're going to outlive their money. So the distribution phase is when you take out income. The last phase, some people don't think about it, it's the transfer phase. It is where whatever you have in a nest egg that you had when you passed away because you wanted to have something there to sustain you as long as you lived. People usually leave behind something that would have sustained them had they lived longer. When you transfer that money to your spouse, your kids, or whoever, people sometimes get shocked with what is being taxed at that phase. So we have the contribution, accumulation, distribution, and transfer phase. Now, there's basically 5 different savings alternatives when we talk about being taxed in the 4 phases. So the first one is the worst way to save, but the most common way Americans save. This is in taxed as earned accounts, where you put money in a bank, a credit union, a mutual fund, and every year they give you your interest statement and you put it on your tax return and you pay taxes as you go. Let me tell you how bad it is. If you had $1 and you doubled $1 every period for 20 periods, what would it be worth? $1 goes to 2, 4, 8, 16, 32, 64. In 20 periods, it's worth $1,048,000 if it's tax-free. If it's taxed as earned, $1 doubles to $2 and you get taxed at 25%, you only have $1.75. $1.75 doubles to $3.50, you pay tax on that. Do you know how much you'll have instead of $1 million? $72,000. 7.2% of what you could have had. In a 33% tax bracket, which many Americans are in, many Californians are higher, you'd only have $27,000 instead of $1 million. That's how most Americans save. Some people take after-tax dollars and put it into a deferred annuity. If we were running $1 million dash around a track, and the goal is to have $1 million net that is ours to buy gas and groceries, prescriptions and golf green fees. The first method, taxed as earned, would be like crawling around the racetrack. You'd only be 2.7% of the way around the track when, with my favorite vehicle, which I call the laser fund, you'd be crossing the finish line with $1 million tax-free. If you take after-tax money and you put it into a deferred annuity, that's like walking around the track. So let's go to IRAs and 401ks. Here you're running around the track with the wind at the back at the beginning of the race because you get to use pre-tax dollars. You get to tax deduct it. But then when you're coming around in retirement, the back nine of an 18-hole golf game of life, let's say, retirement, now you pay tax. And so you got the wind against you. And you got inflation, and people outlive their money because of taxes, inflation, and market volatility. And so that's jogging with the wind at the back at the beginning, but it is really hard at the end, retirement. Now, Roths, you are running around the track, you're jogging, and you have the wind at the back at the end of the race. You pay tax on the front end, your contributions, but on the back end, now you have money tax-free. That's the wind at the back during retirement, and I can prove to you mathematically that if you believe, like most Americans do, that taxes will eventually be higher, then I can prove to you a Roth will generate or provide probably 30 to 50% more in net spendable income than the same amount of money in a traditional IRA or 401k if taxes go up, okay? Now, I don't own a Roth. I own a laser fund because a laser fund allows me to be able to put in after-tax money. Actually, I'm a financial strategist, so in all my books, I show people how to get the deduction indirectly. So I can use 100% tax-free contributions if I want. But the most important phases are the accumulation and distribution phases. I can accumulate my money tax-free. I can take it out tax-free. People say, well, it sounds like a Roth. No, Roths do only that. Mine, when I ultimately die, blossoms, doubles or triples and transfers tax-free. If I died tomorrow, every million would blossom to about 2.5 million in my laser funds. And it doesn't cost me anything. It's not free, but I'm not paying for it. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary income tax. But I can use indexing. I can earn rates of return averaging 6 to 10%. Most Roths and IRAs or 401ks in the market only average 3.49%. I'm earning twice as much, but it's tax-free. So this is what is called the 4% rule in the financial services industry. The 4% rule in the financial services industry means this: because most Americans have their money in yet-to-be taxed IRAs and 401ks when they retire, and that's usually invested in the market. Wall Street was never built to sell. If you ask, stockbrokers, Wall Street, when is the best time to sell my stocks? What's the answer? Never. It was designed to maybe accumulate money, but never create predictable income because there's too much market volatility. And that's what happened in 2001 to 2003 after the terrorist attacks. That's what happened in 2008 during the mortgage meltdown. People lost 40% in the value of their IRAs or 401ks. It took 4 years to make back what they lost. They had to put off retirement 7 years. You need predictable income. So I've helped many, many people get their money strategically out of IRAs or 401ks at least 5 years before they retire and convert it into something that's going to be tax-free and not subject to market volatility. Get it out of the market. But because most people have money in the market, Dalbar, who studies investor behavior, says if they left their money there alone, they would probably average around 9.6%, maybe 9.4%. If they earn $1 million ought to generate $90,000 a year without depleting principal, but you have to pay tax on $90,000. In a 33% bracket, you're only netting $60,000. Most people are not earning 9 because they're buying and selling at the wrong times. The market starts to go south, and when it gets down about 20 or 30%, people go, enough already, and they sell low. And then they wait until the market's up here, and then they buy again high. So the actual average rate of return for retirees on their money in the market is 3.49%. That's why the financial services industry says we don't want to be sued for you outliving your money. You can only take out 4% a year. It will slowly deplete your nest egg because you're only earning 3.5%, but not before your LE. LE is life expectancy. If you take out more than 4%, you have to sign a waiver that you will not sue them, a hold harmless. So do the math. You have $1 million nest egg, you pull out $40,000 a year, pretty pathetic. You have to pay tax, even 25% tax. That's 10,000 of the 40, you're only netting 30. Most asset managers charge you 1% on the million, that's another 10 grand. You pull out 40, you subtract taxes and fees, you're netting 2%. My laser fund, $1 million, I can pull out 60,000 tax free, it will never deplete based upon actual history in the worst of times. How much better is 60 than 40 or even a net of 20? Because my 60 is tax-free. But I've actually been able to withdraw 80 to 100,000 a year tax-free. What would you rather have? 40,000 and then have to pay tax on it? Or would you rather have 80,000 totally tax-free? I think I know the answer. If this intrigues you, let me show you how you can study and read about this and empower yourself to do something better than an IRA or 401k and actually be in a zero tax bracket. We've helped many, many people who were in the highest tax bracket. And in 5 years, they now are in a 0% tax bracket. The IRS knows they're getting $500,000 a year, but they know it's not taxable. It's a sacred cow. This is not a loophole in the Internal Revenue Code. So don't miss out. Let me show you how you can learn. So as I mentioned, I love to educate people. And my most recent best-selling book here is called The Laser Fund. It's a 300-page book. About 200 pages is all kinds of charts and graphs and explanations of how this works, how to diversify and create the foundation for a tax-free retirement. If you learn better by stories, you flip it over and you read this one. And if you want to use your whole brain, you can read both books, okay? But I want to gift this to you absolutely free. If you go to laserfund.com, L-A-S-E-R fund.com, you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I will pay for the book. There's also options there to listen and learn, watch and learn with all kinds of education, because I believe in empowering you to take ownership for your brighter future.